Welcome to Mad Money. Welcome to Cramerica. Look, my friends, hey, I'm just trying to make a little bit of money here. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. You never want to see what's happening right now in the stock market. You see, the market's developing a thesis, and it's not the thesis you and I were hoping for. You can't really spot it in the overall averages. Dow slipping 42 points, S&P losing 0.53%, but the NASDAQ tumbling 1%. But underneath, it's there, and it's not good. What am I talking about? Simple. The wrong stocks are going higher. Let me explain. In a good market, you want a broad rally led by growth stocks, with the cyclicals taking a back seat but still going higher. It's just time, for example, it's okay if the Magnificent Seven rally. By the way, also with their adjacencies and accoutrements, it would help if the bedraggled software stocks could move higher, too. They've been awful. Tech's a huge percent of the S&P 500. It makes for a tremendous leader. I also like to see the transports rally because they represent the health of the economy.
All aboard!
Most of all, I like to see the bank stocks go higher. When the banks are winning, it tells you businesses are expanding, need loans, companies are coming public to raise capital, we have mergers and acquisitions galore, and individuals are taking out loans, maybe to buy houses, maybe to renovate. At the same time, I don't mind when high growth stocks, like Eli Lilly with its GLP-1 diabetes and weight loss drugs, keep moving higher. That's very positive. What I just described is the jovial bull market we had most of last year. Today, though, we saw something very different. This was a market where the winners were consumer packaged goods stocks and the oils, the worst possible leadership groups. The consumer packaged goods plays are recession stocks. The oils are zero-sum. Right? That's the kind of relationship they have with the rest of the economy. At the same time, the banks are in free fall. Whether they missed earnings that were just reported or not. I'm going to have more on that group later. Problematic. But let's just say the market's reaction to these numbers was just plain miserable. We'll go into the reality of the bank earnings, but there's a clear perception created by the bankers that if the president puts a cap on credit card rates, like he says must occur and that he's going to make happen, the entire economy will be trashed. I don't disagree with him. If you cap credit card rates at 10%, then most people simply won't qualify for credit cards. The default rate for these things is 3 to 5%. It's just not worth the risk for the banks to give you an unsecured loan if they can't charge extortionate interest rates if, well, you spend some time paying them and not paying them back immediately. The only people who qualify for credit cards are the ones who don't need the money. And that is a recipe for economic disaster.
Sell.
Now, I don't think something like the cap will really happen. You need Congress to make the law. And if Trump tries to browbeat the banks into losing money, they probably won't roll over. But it's still a risk. And it's not something shareholders want to worry about. And of course, it's not just bad for the banks. It'll also be really bad for retail and traveling, a host of other discretionary products. I think that today's market reflects Trump's persistence on this issue. He's not going away. You'd think capping credit card rates would be more of an Elizabeth Warren, Senator of Massachusetts kind of thing. She thinks, by the way, that all the bankers are like Potter and It's a Wonderful Life. It's a surprise to see this coming from a Republican. But then again, when it comes to the credit card business, I imagine most politicians think that Tony Soprano had more reasonable rates. So again, I think this policy is unlikely, but the fact that people are seriously discussing it enough to scare investors away, right? I think it's driving money out of the banks into a whole lot of other sectors. We also live in a points economy now. The banks don't make much of anything on points, but the retailers and any of the myriad outlets and outfits that offer them would see their businesses take a severe, ugly hit. It would be a nightmare. It would be like Saks all over again, and a whole bunch of other places. So no credit for tens of millions, and no points either? I don't know. That seems scary to me. The president's always talked about booming economy, but if you tamper the credit card market, I got to tell you, you're ensuring that the economy goes bust. And that's why I'm so dismayed to see what we call the CPGs, the consumer packaged goods stocks running today, because that's exactly what you buy if you think the banks will more or less withdraw from the credit card market to cope with a very damaging policy. So let's talk about Procter & Gamble, and then let's talk about a pharma company, J&J. Now, here are two companies that have products that you buy no matter what. You need toothpaste and medicine, regardless of how the economy's doing. J&J can thrive in a weak economy. If you look at the chart of the recent action, you might think it's found maybe the fountain of youth. J&J deserves to be going higher, but not at this speed, not at this pace. It's only rallying like this because a lot of money managers went to bet on a slowdown. They are passing on Eli Lilly now because it has a much higher price-to-earnings multiple, and those kinds of stocks are too risky to buy. Procter's a different kettle of fish. They have already told us that business isn't that hot, and they have lots of problems. So be prepared for the worst because they've told you the worst is coming, and they might exceed that. Yet its stock went up big today. That's because even if it's bad, Procter & Gamble is still going to do fine versus the cyclical stocks, which are going to get crushed. When you see this one rallying on bad numbers, it's a real tell that things could go south. We bought Procter for the Travel Trust totally just as a hedge, hoping that we don't get a weaker economy. On a daily today, it's coming in very handy. Maybe you should have a hedge, too. Normally, I'd say that this minor chord might just last a little while, a couple of days, until we put the bank credit card assault to bed, or we get more great home sales numbers like we had this very morning. I'd assume this sell-off was just temporary. Unfortunately, there's another wrinkle. Oil looks like it's headed higher, even if it finished the day in the red, because the president's $50 barrel plan is suddenly going the wrong way, thanks to the newfound uncertainty out of Iran and the facts on the ground in Venezuela. You take out Venezuela's leaders and oil goes lower. You take out Iran's rulers and you better believe it goes higher. The result, the real leaders in this market are Exxon and Chevron. Both have tremendous CEOs. Both have long historic records. And both represent the very problematic leadership we don't want. The type that keeps you and me up at night. And not just because my wife Lisa just had her knee replaced and there's no sleep to be had without Oxy. And I am not talking about Occidental Petroleum. Lisa's no sissy, though, and she wouldn't take the Oxy anyway. The problem with the oils is that energy costs are a tax on the entire system. So when this group wins, it means everybody else is losing. The bottom line, we have to hope that these two new leadership groups aren't long-lasting. I don't think they will be. You also need to have some hedges, some Procter, some J&J. Hey, listen, I'll throw in Colgate and Merck if you want to. Just something that keeps you in the game until things get better. You know why? Because they always do. Hey, I want to go to Brett in California to start. Brett.
Jim, thank you so much for adding my call to your show today.
Oh, Brett, I'm glad you called in. What's up?
Jim, I have my colleague Matteo Ritter. He's a first-time investor, and we were discussing metals. He likes silver and aluminum. I started a position in copper, Southern Copper. I just want to see if I should keep adding to it.
Look, I don't mind Southern Copper, but copper has run a great deal, and you've got what I call a parabolic move in Southern Copper. It was up $5 today. It's no longer got a cheap earnings. Up cheap dividend. It's 1.98% yield is all you get. The stock's up 25% this year. I got to tell you, Brett, I think you're late. I can't condone it. How about your friend? Let's go to John in Florida. John.
Hey, thanks, Jim. I was wondering if you could give me an update on AutoZone. I've been watching it for a while, and I watched it go down till the end of the year and then a little bit more in January. Last week, I couldn't take it anymore. I bought some. And I'm wondering if you could explain why it's down to like a 23 PE when O'Reilly is still a 33 PE, and their earnings and growth are still good.
Yeah, people didn't like that last quarter. And the reason why the stock is going down is this company is so darn consistent that when it reported an inconsistent number, I can't believe the jailbreak. I think they're fine. I think the next quarter is going to be better. This company always pivots and always pivots well. I'd be a buyer. We have to hope these new leadership groups don't stick, but it's always worth having some hedges to keep you in the game until things get better. I suggest Procter & Gamble. On Mad Money tonight, earnings season has officially kicked off for the big banks, but Wall Street didn't like what it saw at all. What went wrong with this? I'm digging into the situation. Then tech stocks have struggled to find their footing in the tape, but there's one corner of this sector that's actually working. I'll reveal the names when I go off the charts. And Biohaven, BHVN, had some positive news to share at the JP Morgan Healthcare Conference, maybe better than last year's disappointments. And we had a chance to sit down with the company's CEO while we were out in San Francisco. You do not want to miss this exclusive. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.